All right, I want to welcome everybody to our next segment here. And I'm here doing this pre-recorded with some of our awesome TD folks. And I always got to say, you guys are huge supporters and we love the partnership that we have with all of you. So I'm here with Beau Cotey and Jessy Bilodeau and Mario Damjanovic, who is Damjanovic. Did I miss at the end of it? Okay, Damjanovic. There you go. Perfect. And we want to talk about the CMHC changes, how it's going to affect things. And I like the fact that in our little preamble here, it actually like there's a bit of a silver lining here where we're going to get through this. It's probably not going to crater things like some people might be thinking here. So I'll tell you what I'm going to do is I'm going to step back. I want to start off with Beau, who's regional manager with TD here. And Beau, take us through, introduce your team here and just, kick us off on this.
Awesome. So thanks, Lindsay. And thanks everybody for letting us jump on here. We truly enjoy being out with you guys and getting on these calls because it's just, our biggest benefit to being a partnership with you guys is providing information and education. So when we get this information, the first thing we try to do is get in front of you to make sure that you guys are feeling comfortable about what's happening out there so you can speak to your customers as you guys are out there selling houses in the market. So today I got Jessy Bilodeau and Mario Damjanovic with me, both 10 plus years supporting CIR, and I couldn't bring two better people on here. And the longest standing MMS reps supporting CIR, because we do have ones in other offices, but they're shorter timelines. And so I thought I'd get two of the best in the business to be here to talk about this information with you guys. So I kind of want to kick off the call before I turn it over to Jessy, Mario, just explaining a little bit about why CMHC decided to go down this route. Okay, so and more specifically, only CMHC. I'm not talking about Canada Guarantee or Genworth, just CMHC. So part of the reason the Bank of Canada had gone in and started to make this change is from what the data tells me, and this has gone direct information from CMHC, is that we're starting to see CMHC forecasts between 9 to 18% decrease in house prices over the next 12 months. Again, a lot due to the pandemic. We're starting to see that things are starting to open up, which is great, and we're starting to see the environment change where people are getting a little more optimistic, but we can't downplay how bad a virus is until we actually have a vaccine. And China is a great example. They're starting to kind of see it turn around and become more of a problem all over again. And so we need to be very diligent in how we manage and do our social distancing in Canada. But this is kind of the stats they're seeing, is that we're going to see a bit of a decrease over the next 12 months from a price perspective. Now, that could turn around if a vaccine comes out, and very much could turn around if we get a hold of this in Canada. So still very optimistic that we will move in the right direction. But again, they're starting to see a bit of that. They're also seeing that the increase in indebtedness of borrowers in Canada has increased to the point where I think the last stat I read, we're actually higher than the US per capita. So we have more debt per person for individuals in Canada than we do the US. So and then there's been a lot of talk around what that looks like in Canada, and should we allow people to do home equity line of credits anymore, because we're giving them a revolving product, a security against their home, which they continue to rack up and never pay back interest only. So there's been a lot of talk about what we do with that, but the banks are very firm on never changing that product because it's a great flexible product to have. But what's happening now is we're seeing during the pandemic a lot of racked up credit cards, a lot of deferral payments, and people using the deferral money instead of smartly, they're actually turning around and using it in other places and then putting themselves in more debt. And so what CMHC has done, and again, this is just information from them, is not them, Bank of Canada has come back and pushed CMHC to say, we need to make a change to be able to protect our customers long term. And so what this change is doing, and they've done a lot of research, is the change is just trying to take away the ability for homeowners to get in over their head. We know the qualifying rate came about to stop people from being able to afford things that are outpriced, and then when interest rates change, they can't afford payments anymore. Well, this is just another step in that direction to make sure that we aren't allowing the people, majority of homeowners that try to step into a house and they have a great price point at 300, but they're like, you know what, let's buy my dream home today at 600 instead of waiting, and then putting them into a position where they can't afford those payments longer term. And then a furnace goes, and then their credit card maxed out, and then they lose their job. So because of this pandemic, it's really made the economic stability in our economy very uncertain. And so we got to make sure that we step forward in the right direction. So CMHC put their foot forward, and they're not a privately owned company. And because of that, they have to operate under what the Canadian standard guidelines are. And so I'll let Jessy talk a little bit about the changes, but just to give you guys a bit of background, the Bank of Canada is really looking at the financial health of our consumers out there and people buying homes, and that's kind of why this decision was made.
Perfect. Thank you so much. Jessy.
Right. So there's three changes that are coming through as of July 1st, and again, only for CMHC insured mortgages. So number one is that one borrower has to have a minimum beacon score of 680. So if there's two borrowers on the application, if one's below 680 and one's above 680, that's still going to be an application that can go forward. So the first point is the beacon score is now going to be looked at more closely. The second thing that's changing is the debt ratios. So maybe just to break that down a little bit, there's two debt ratios that we look at, the GDS and the TDS. The GDS is basically your qualifying mortgage payment, property tax, heat, half the condo fees divided by your gross income. That used to be a number of 39%. Now on CMHC deals as of July 1st, the maximum that number can be is now going to be 35%. So there's a 4% difference in that number. Mario's going to talk a little bit later, some specific examples and break that down as far as like a numeric value for you guys. As far as TDS goes, that's all the same things that are included in the GDS plus any debt payments, so loan payments, 3% of any revolving credit such as credit cards. The maximum was a hard 44. Now with the changes for the CMHC deals, it's going to be a 42% max. So a 2% difference in the TDS number that we're looking at there. The third change that's coming is related to the down payment. So in the past, there was regular down payment and non-traditional. Non-traditional basically meant borrowed funds. So someone could use an unsecured line of credit, use that as down payment, and as long as they could service the payment on that, borrowed funds were allowed. So for the CMHC deals only, as of July 1st, the non-traditional down payment will no longer be allowed. Having said that, gifted down payment is still permitted. That's considered a traditional source. And clients who have an existing home and maybe keeping that as a rental and buying an insured one as their principal, if they have equity in their home and they have a home equity line of credit, even though that's in a way borrowed funds, they're actually using their equity. So that is still allowed. It's considered traditional. And so that'll still be allowed to continue to go forward. Lindsay and I were talking just before the call regarding how the bank will manage this. So like right now in our underwriting center, there's a certain percentage of files that automatically go to CMHC and some go to Genworth and some go to Canada Guarantee. The bank's stand on this is that this is going to be a seamless process for the clients going forward. So if we submit an application and that buyer doesn't meet the requirements of CMHC as of July 1st, that application will automatically be rerouted to one of the other insurers that we work with. So as far as a application process, everything is going to continue quite fluidly from here.
Nice. So that actually people that need that extra little help can go to these other lenders.
Yes, that's still an option. Yeah.
Now, let me ask you one more question on this too. Is this something that affects just first-time home buyers, or is this all buyers now that are going to have an insured mortgage?
It's all buyers who have a CMHC specific insured mortgage. So if it's a new application, we are always going to have the choice whether it goes to CMHC or Genworth or Canada Guarantee. So we can funnel it to the insurer that's going to have the best fit for that client. The only situation that I'd say where it would have to go to CMHC is if a client was selling and buying, they had an existing CMHC mortgage on the current house, and they want to use the top-up premium or port their current premium. In order to port the existing CMHC fee or utilize the top-up option that CMHC has, in that case, they would have to stay with that specific insurer. But outside of that, we would have the choice to play around with it.
Great. So Mario, it sounds like you're going to show us some examples of this.
Well, so you know what I'll do just before I turn over to Mario, I just want to talk about just the stats on, so CMHC, I did go to CMHC because in the news, it seems like the poor insurer is being penalized and they're saying, sorry, we're we're not doing any business. But I want to really just quickly talk the true impact of what those deals are, and then I'll turn it over to Mario, because I think it's important that people understand CMHC is still a very strong contributor and they will do business. So some of the averages they have on the three things that are coming, they told me. So for the new minimum beacon score, the average credit score that insurers originate is 756. That's the average credit score that they get for their deals. 94% of the deals that come in are above 680 credit scores. So that tells me that really it's like a less than 6% chance that customers will not be able to do business with CMHC based on credit scores. From the ratio perspective, for your gross debt, your GDS, and your TDS, for your total debt, the average GDS is about 27.8%. 80.5% of deals come in below 35% GDS. So 80%. So 20% of them are above that threshold of 35. And on the TDS side, 37%, at 37%, 80% of those are less than 42%. So really 20% of the deals that are going to go to CMHC probably won't be adjudicated by CMHC. So I think it was really important for me to come back, as CMHC is a great partner and they give us a lot of information to support them. We will still use CMHC for deals to get done. The benefit of having other insurers privately owned, like Genworth and Canada Guarantee, is we don't have to use CMHC when the time is needed. So when those people, the 20% that don't fit the criteria to go to CMHC, what we do is filter them over to the other insurers just so that the business continues to happen.
And as we talk about with Mario, I guess the question too is not that you can't buy a house, you just have to buy less house to get your ratios back in order. But now obviously the credit score, the beacon score, it has to be in place, but we talked about that's such a tiny percentage, but the bigger one is getting your ratios in place. So you just have to buy a house that's more within a price range that is more sustainable for you based off of CMHC's comments, correct?
Yeah, that's right. That's basically it, what it comes down to, right? So it's not necessarily a no-go. It's just what other options do we have to look at, right? More often than not, we don't have clients that come in and say, oh my God, I have to be with Genworth. I absolutely love Genworth. Most clients don't know who the insurers are. They're happy to get the mortgage approval. That's the more important thing to them, right? So that's kind of where we guide them through that. So it's not necessarily an issue where it has to be one insurer or another, where someone has a preference, unless, like Jessy said, it may be a situation where they're moving one house to another and then they're looking at doing a top-up or a port, so to speak, with a top-up premium or something. In that case, they may be limited, but otherwise, typically it's not something that would limit somebody. Just to kind of speak to some of the numbers here, I can definitely, I'll share the screen here. And I did just a bit of a couple examples. Now, again, these are very specific, so it kind of gives some specific parameters. Can you guys see that okay?
Got it. It's perfect.
Wonderful. So on here, you'll see some of the parameters I used, and I just kind of tried to capture what an average client might look like clients that we're seeing out there and that a lot of realtors will be seeing as well. So for the first one, I did kind of the top one there being pre-July 1st, bottom one being post-July 1st to kind of show what the difference would be. So we have a set of clients here looking ideally at a $500,000 house originally, pre-July 1st. They have 5% down or $25,000. And we're assuming an income of $100,000 annual combined household income between, let's say, husband and wife, just a typical common scenario, right? So we're using 83.33 monthly for the calculation, and I've just converted all the payments monthly for what a qualifying payment would look like. Now, these numbers, those that are a little more familiar with the way debt ratios work, this is all based on what the GDS ratio would be, the gross debt service ratio, which is essentially based on the house. That's the one that's looking to be decreased from 39 to 35. So that's going to be the biggest impact. There is another debt ratio, but again, it's for total debts, and that it starts to muddy the waters a bit if we go into too many scenarios. There's 1,000.
Oh, I like this.
Yeah, this is just a simple way to look at it and just to get an idea as to what the impact would be. So in this example, 500,000, 5% down, the mortgage qualifying payment, QP, would be $2,856. Now keep in mind, that's not the client's actual payment. That's based on a 4.94% qualifying payment based on the government regulation there, or their subscribed rate. Property taxes, I'm just estimating around $285. It really depends on the property, up or down from there. And heating cost, again, I just use an average square footage. Assuming it's a single family house, I use $22.50 for square footage to base my heating cost on. So total housing expenses, $32.51 would work out to a 39% GDS, which is kind of where the current cap is rather. Now, post July 1st, I've kind of used an example of $450 to show what it would look like if I just decrease the size of house, decrease the property tax, and obviously the mortgage amount. So as you guys will notice, the down payment will also decrease slightly. Income remain the same. We're using the same clients. Total expenses go down by about, what is that, about $340 or so, $335 is what the decrease is. So that impact, based on what it would be for buying power, works out to about a $50,000 difference, because you're seeing the purchase price there at $450 in order to keep the debt ratio in line at 35 based on the new debt ratio qualification that they're allowing us to use. So that would be an impact for someone in this kind of specific scenario, but this is a fairly common one that we do see with customers.
Yeah.
I did a second one here as well, actually. And I did one for, let's assume it's a condo. Let's say somebody, this could be, again, household income or single person, regardless. I use annual income of $75,000, assuming a bit of a smaller purchase price, because there's going to be a little bit less of an impact. So we started with $350,000 pre-COVID, or, oh my goodness, pre-CMHC change, my bad. Yeah, so many things going on. It's hard to keep track of what's what. I know,
I get it.
So we're using $350,000 purchase price, again, 5% down, same qualifying payment. The only difference here is instead of counting a heating cost, I'm using a condo fee. Now, we only use 50% of the condo fee to consider what that would look like for heating and utilities and everything. So that's just the way bank policy is, to use 50% of that. So based on that, we would start with a $350,000 purchase price, which would get us to the 39% once we use all the qualifying payments. And that's where we would cap off that. The second one here, based on post-July, all I did was tweak the numbers again just to see what it would look like at a lower purchase price. So we used $320,000 with 5% again, reduce the qualifying payment, reduce the property tax that it would be on a lower priced property, and I even reduced the condo fee, assuming it's maybe just something to kind of offset that, to show maybe it's a different kind of building altogether with a lower condo fee. It still assumes a total $400 condo fee though. This one would then cap it off at 35%. So that would be a kind of an impact to somebody looking at buying a condo, for example, downtown.
Nice. So my brain is very linear. What I'm looking at here, and obviously the condo fees skew the numbers depending on obviously the building that someone's buying into, but at 500,000, we saw about a 10% reduction in purchasing power. At sort of this 350 range, we're seeing slightly less than 10%. But still, if we were to kind of in our brains think about it as 10%, I feel like that's easy for me. Am I off base on that? Or is this sort of like something that we can kind of say that if someone were to have the changes, we'd go dollar for dollar, that 10% is sort of a number to look at as a decrease with the new GDS ratio changes?
It's a good benchmark to use, but it really, really depends on the person's, income. It depends on if they're buying at the top of their budget. It depends on what the condo fee may be. It really does depend. As a rough benchmark, I would say sure, 10% is a very rough benchmark, but keep in mind that, and that's only for the ones that are impacted by CMHC and have to go, or that we must go CMHC. Other insurers, if it does end up being a problem where we notice that our debt ratios are off, we could always go and consider a different insurer. But yes, if it is CMHC, approximately 10% impact, but again, it really depends.
And as a recommendation to all clients, I mean, of course, this is human nature. We talk about, spending what we have, but, we're assuming that people are butting right up against their upper limit based off of what they can afford. So, so probably a little bit of prudency here. But I love what you guys are talking about here, because this is sort of the final question. We got to wrap up. We're running out of time here. The final question is, pull the crystal ball out now, and do you believe this is going to impact the market? And I love what you guys are saying, that there is alternatives out there for people that are bumping up against the upper limit here. So, Mario, I'll start with you. Impact, do you think this is going to be widespread? Do you think this is another punch in the gut, or is this going to be okay?
In my personal opinion, out of all of the different changes we've had over the past couple of years and all the regulation changes and all of that, I think this is the least of our worries. This is the smallest one that'll impact us. Especially because realistically, there is really no impact if we use a different insurer. If and when those clients come up where they are at the upper end of their limit, it really shouldn't be an impact to us. The 1% or 0.5% of clients that are looking to sell their house, move into their new house, and that they're going to be doing that top-up porting of the CMHC premiums, that'll be the one scenario where maybe they get impacted. But even then, if they qualify, if their income's strong enough, it may not even impact them at that point. So really, I think it's going to be a very minor blip.
Awesome. Jessy, anything to add to that?
Yeah, I would echo that it's going to be a small percentage of files that it affects. And I think that, there's no need to panic with these changes, because we do have the other two insurers. And based on the stats that Beau said, if the prices do drop, what CMHC is predicting, then that client may be able to get that exact same house at a lower price because of the price drops that have occurred. And really, I don't know how much impact that would have on them at the end.
Yeah, fair. And Beau, final thoughts here?
Yeah, no, I completely agree with Jessy and Mario. I think I don't have a crystal ball. I mean, I was surprised CMHC rolled this out now because they're legislated by the government. They kind of got to follow suit. The other two insurers, I mean, like what we saw with the change of the qualifying rate, we had small credit unions that weren't supposed to follow, but they did anyway. So could the other two insurers follow? They could, but I think when we take a look back at the grand scheme of things, we saw that 20% of those deals would be impacted. So like Jessy said, if we see a decrease, they're kind of offsetting, they're hedging their bets. If they know the decrease in prices are going to go down, they'll still get the same amount of business because those higher price deals probably aren't happening. And because we're coming down between 9 and 18%, you're going to make up that 10% gap. So they're probably going to get those deals anyway. So I think that's kind of the way to look at it.
Awesome. And I love what you guys are talking about. The good news is this is sort of a breath of fresh air. I think people really are seeing this as a gut. I don't expect in Calgary here to see that 18% price decrease that people are talking about. I mean, I feel like we're getting through this. We're feeling a spring market out there right now, which is obviously a feeling of pent up demand from that. I think the March and April sales and May sales that didn't potentially happen, we're feeling it now in June. So that's good. But obviously a lot of stuff to come with job losses and things like that. We'll, kind of tiptoe our way through it. But it's nice to hear that especially TD is stepping up for their clients, looking at alternatives, making sure that the home ownership dream is still alive. So I think that's outstanding. And I want to thank all of you, Jessy, Beau, Mario. Thank you all for coming on and providing so much value to us.
Thank you.
You're welcome.
Awesome. All right. All the best, guys, and we'll talk to you very soon.